What's up, fellow traders? It's Edward with Crypto University. In this video, I'm going to be talking to you a little bit about leverage and how you can understand some of the concepts to make you liquidation proof. So whenever you take a leverage position, it means you're trading on a position with more funds than you actually have. So for example, looking at this account right here, using 100% of my funds would be $736. If I apply 10x leverage, I can trade with 10x the funds that I really have, right? So let's just set this up to 10x real quick, and then I can scroll down and see if I select 100%, it's going to change my amount now to 7,361, right? So that's easy enough to understand. Whatever leverage amount you put here, it'll multiply your available amount. So if I go back to 1x, put it to 100%, you see $736. I put it up to 20x and press 100%, it's going to change that now to 14,722. So let's take that back down to 10x and we'll see 7,361. So now let's talk about your return factor. All right, so now using the same example here, if you're using 10x leverage and the market moves plus 1%, right? It means you gain 1% on this position. With 10x leverage, it's going to make your return on investment or return on equity 10%. So your return factor is going to be multiplied here as well. So let me just scroll down here and show you some examples. This is an easy one to understand. Here we have cross 10x, so that's 10x margin, right, on $100. This is a very easy to understand trade. So we used $100 in this trade, and it made our position a total of $1,009 because we used 10x margin, right? So $100.96 became $1,009.62 because we used 10x margin again. Now we made plus 0.038% profit, right? Well, that's not that much, you'll say, but we're using 10x leverage. So again, it multiplied our return here. You could see return on equity 3.80%. So we scalped 0.38% and made it a plus 3% return, right? And that's $3.79 off $1,000. So this right here is a fine example of how you can multiply your returns. Here again we see cross 10x. Here you can see plus 1%, and that multiplied by 10 is 10.80%, right? So we made $10 here off of $101, right? We used 10x cross that made our position size $1,011. So we made $10.92 off $101. So that is a 10% return on equity. Even though the market only moved 1%, we were able to get 10% returns back. So that is how you can use leverage to multiply your earnings substantially. Now let's take a look at how to support your margin, right? So let's come back up to this example that we're using here. Okay, so using 10x leverage on this position that I had here, if I were to use 10x leverage and the market moved 10% in the positive direction, then that would make my return on investment or return on equity 100%, right? So I showed up with $736 to this trade. Using 10x leverage gives me 7,361 to play with. So then if I make the 10% off of that, it would be $736, right? So I doubled my hand. But let's say if price goes in the opposite direction, price falls 10% in value. Now the $736 that I put into this trade is going to be wiped, right? If I don't have any marginal support and this falls minus 10%, I'm going to be liquidated if I didn't have any marginal support. So you need to plan for that before it happens. You need to plan for market movements before you ever get into a futures position. The last thing you want to do is end up in a futures position that's going south or losing that you don't have an exit plan for. So how can you avoid liquidation, right? Well, there's multiple things to consider before taking a leverage position, but let's talk about the two most important ways to avoid liquidation. So the number one way, easiest way to do this is planning for deviation or by planning a stop loss, right? So if you're looking at this particular pair at this particular date and time, and you say you want to plot your entry right around 33710, set our take profit price, so that would set our TP just above where current market price is now, and then we can set a stop loss. Okay, well, If price falls, that looks about reasonable, or we could even move it down. If price falls below 316.65, I want to get out of this trade, right? So that's the number one way to avoid being liquidated, is using a stop loss. Now, if this occurs, you're going to lose some funds, right? That's why a lot of traders don't like to use stop loss. So if you don't like to use stop loss, like myself or some other people I know, then you need to manage your margin or risk exposure properly. So let's just say, for example, you're using 10x leverage on your trade. You shouldn't be using a position size more than 10%. You're going to say, well, why would I use leverage if I could just use my entire position size, right? Because 10% at 10x is 736. Let me remove this leverage for you all the way, right? So 100% now is 736. We slide that up to 10x and we go 10%, 736, right? Okay, well, I could just do that without leverage. Yes, you could. So then your 5% would only be 5. But with 10x leverage, it would be 50%. If you change that up to 7%, with 10x leverage, it would be 70%. So now you'll be making 70% off your $736, except you won't have the fear of liquidation. In order for you to be liquidated at this method, price would have to fall 100%, meaning it would have to fall all the way down to zero. There you see 99.99%. If it goes down 100%, the asset's gone to zero and you'd have lost all your money anyway. So, that being the logic here, this would be an anti-liquidation method. If you have one trade abiding to this guideline, then you will be liquidation proof. So this scale is directly proportional. You can do it if you were running 20x, then you would have to be using 5% of your available capital, and that would make it the amount of money that you actually have. So now you're trading with that, and if the market moves, let's say, make this easy for math, 10% at 20x, that's actually 200%. So if you weren't using leverage, you only would have got 10% out of your $736. But since you're using 20x leverage, now the market's moved 10%, you made 20x that. So you actually made 200%. So you turned your $736 200%. And you did this all while being liquidation proof, while not having to worry about the fear of liquidation, while not having to use a stop loss and worry about getting stopped out of your trade for a loss. You can actually make a profit on your trade. If you went up to 50x, you would have to use 2% of your available capital. So $736 would be 2% of your available capital at this point. And we don't have 100x on this contract, but if you did use something like BTC that offered 100x on your contract, then you would use 1% of your available capital, which would make it $736. By this example, by the amount of money that I had. So you would have to calculate this for your own bag, and the easiest way to start off is to use 10% at 10x. It's the best way to wrap your head around this, 10% at 10x, and you shouldn't go wrong. If you want to go 20x at 5%, you shouldn't go wrong. It would be pretty easy to keep up with these numbers here. Think like this. So if you were using the entire 100% of your balance at 50x, that means the market would only have to fall minus 2% for this position to be wiped without any marginal assistance. If you were trading with $36,806 and the market fell minus 2%, you would lose $736, meaning your position would be wiped. But if you were trading at 50x with only 2% of your available capital, that would be $736. So that means your marginal maintenance would be able to support that, right? So if your initial position was wiped, if you were trading with $736 and you lost 2% on this trade, you would be able to sustain your margin because you're only using 2%. So as the price falls 2%, your initial input is wiped. So let me just show you. I'm going to press confirm here. 2% at 50x. And I press the buy order to come down here. So now you can see at 50x cross, using 2% of the balance of my available balance, I only used $14. So now, as price falls 2%, it's going to require $14 additional margin. So at 4%, I'm going to need $28 to keep this position alive. And at minus 6%, I'm going to need to add another $14 to that. So I'll need to have $42 to keep this position alive. At minus 10%, I'm going to need to have $140, about $147 to keep this position alive with margin. use at 50x. So as you can see, I still have plenty of room to go because my available capital is at $736. I'm going to go ahead and cancel that real quick. Make sure I don't get stuck in that trade. Alright, so I hope that was helpful to you so you can understand how leverage can help you make more money with less money, and how you can also use leverage while avoiding liquidation. If you overexpose yourself to the market, don't get it wrong, you can get liquidated. If you stick to the guidelines and use the proper amounts, you shouldn't experience liquidation. If you get too comfortable with yourself and start making profits, or say, oh, I wish I could have made more profits, believe me, that is when you will start messing up. Slow and steady wins the race. Collect your profits and be happy with what you got. Whatever you can get, take it off the table, put it in your bag, and trade for another day.